I would like to welcome you. I'm Nicholas Borneos of Capital Link. I'd like to welcome you all to the last, but definitely not the least of the sessions of our Norway Maritime Forum. Today's sessions have been primarily focusing on shipping, of course, and on finance. The equity market, the bond market, the bank finance market, alternative finance, and so on. And we are now concluding with a panel on the Norwegian Equity Analysts Roundtable. I will turn it over to Magnus Halvorsen, the CEO of 2020 Bulkers. I think it's very fitting for a ship owner to moderate an analyst panel. I would like to welcome all of them, Frode, Jorgen, Lars, Bastian, Lukas, and Peder. Thank you guys very much for joining. And thank you for your help and support. And all I will say is that Norwegian banks have had a long-standing, unwavering commitment to the shipping industry. And part of that commitment is the quality and continued research that you guys have been providing. So I look forward to Magnus moderating this terrific panel. Thank you very much.
Thank you, Nicholas, and thank you for bringing Capital Link to Norway. I hope we can do this again next year in a physical setting. And thank you for all the panelists for coming. I guess to pick up on your note as an introduction, the Norwegian banks have shown a very steadfast commitment to shipping. I guess we can always wonder whether it's because of true dedication or perhaps just the fact that there are few alternative industries in Norway, but nevertheless, we are very happy to have the panel. I guess we could call it the last survivors among shipping analysts. Whether we were here in New York, it pretty much had to be a Norwegian analyst panel, as most of your counterparts, with a few honorable exceptions, have found new industries or new careers over the last few years. Hopefully that's a contrarian indicator, suggesting that we're still closer to the bottom than the top of the market. But nevertheless, we're very happy to have you here. And I think the whole industry of listed companies are very happy to have your support in good times and bad times. It's an interesting time, and I guess what the difference a year makes. A year ago, we were all, at least as companies, gasping for air, and I think it was a pretty tough sell to be a shipping analyst, trying to find someone who would be interested in buying shipping companies with rates in many segments below OPEX. And I think since then, of course, the market has been surprised to the upside. I at least think about it as two legs. The first leg was perhaps the realization that the world would eventually get through COVID. And I guess we got out of that distressed valuation scenario. That being said, it seems that there's been an acceleration in the fundamentals in most segments more recently, and correspondingly, for the first time in a long time, it's been quite interesting to be a shipping investor. And I think we have some of the brightest minds in the industry on this panel. You spend your time analyzing shipping stocks, but even you, it seems, were taken a bit by surprise. And I think maybe the biggest surprise came in the dry bulk sector. And I'll use an example with the Golden Ocean, which is the Norwegian leading dry bulk company, market cap wise. If you go back to New Year's Eve, the stock was trading at 40, and at least looking at your price targets, which was around 50 kroner on average, it might have suggested you felt, things were pretty fairly valued. Today we're sitting here and the shares have doubled to 80 kroner, and you all have price targets, I think more or less around 100 kroner. So that means two things. It means the market was positively surprised. Something happened that we maybe didn't see. And secondly, you still think there is some upside from here. So I thought it'd be interesting to go around the table and kind of get your thoughts on what's happened. Lukas, you had biggest adjustment to your price target since New Year's. I think you had the price target for Golden Ocean of 35. You're now at 90. So can you talk a bit about what surprised you the most, and do you still think that there's upside from here for investors looking at shipping?
Yeah, sure. I like to arrive when the party is already well underway, so that maybe explains it a bit. But yeah, I mean, you're right. Things have moved fast, and the year sort of started on a cautionary note, and then it took off, and then it doesn't take a lot of time before things are propped up. But when it comes to surprises, I think that we were all sort of surprised on the impact that you have seen coming from China, right? With the steel margins hitting all-time high, the steel prices and iron ore prices skyrocketing. And obviously that brought a lot of momentum into the space. I think that some of that momentum may fade away in the short term. But it certainly sort of made people more, I would say, constructive on what in a little bit longer term perspective was a recovering market.
Yeah. So Lars, do you agree with Lukas? It was mainly the I guess the commodity demand out of China that surprised this market.
Yeah, well, I think that the entire recovery of demand has been very surprising. I mean, the macro guys were always talking about a V-shaped recovery last year, and for the dry bulk market, that has certainly been the case. And I think it's probably not only been China. I mean, as we went into 2021 and into the Chinese New Year's, when Capesize rates corrected somewhat, then I think the fact that the smaller size segments, which obviously are less dependent on China, the fact that they didn't correct is probably some evidence that this is not only China. And I think that sort of widespread recovery in economies of sort of the demand driving regions has been probably the thing that surprised me the most, at least.
Yeah. And what about Frode? You've been around, you've seen good times and bad times. What caught you by surprise here?
No, I agree with Lars that it's like broad-based recovery. It's quite evident, right? You see it in it's not just steel market and iron ore trades. You see it in coal imports, grain, everything is up, right? And makes totally sense if you think about it. Like the fiscal stimulus is thrown around in big numbers, and it has a real impact, right? So clearly, it's I think like what we learned is that it's not really about the inefficiencies in the fleet and temporary shipping supply issues. It's actually fundamental volume-driven markets, and that's what's been the most surprising, I guess, for most people.
Yeah. And you, Jorgen, well, how have you seen this last couple of months?
Yeah, a lot has been said, but I think the main surprise for us was in fact that it was the mid-size bulker market that really kicked off the party, and I think that's a very healthy sign of the underlying dry bulk demand and where it's coming from. Just keep in mind, you know, including grains, around 50% of all volumes carried on bulkers are other than coal and iron ore, which are more China-driven perhaps. And once the recovery story started to play out, you saw a tendency to this starting to happen maybe already in 2019. But other than that, you know, that the mid-size segment is running up ahead of the Capesize segment is not something you see a lot, and should be quite encouraging, just looking at the outlook from here.
Okay. I mean, so far sounds pretty optimistic. What about you, Peder? You had the lowest price target back in December, and I don't think you actually are much higher now. Does that mean you are negative and disagree with your colleagues on the panel?
No, I think we have to admit that we were caught, massively by surprise. Looking into the year, we had a positive view on the second half of the year. The first half of the year, I think consensus was that, although the order book was small, it was pretty front-end loaded, and the demand expectations were for the second half of the year, at least in our case. So I think that was the biggest surprise, how quickly things accelerated, as the other participant has mentioned. One other factor that perhaps hasn't been mentioned is, if you think of the investor focus we've seen over the past year, where ESG has been on everyone's lips, and all of a sudden, coal was, 6 months ago, coal was the worst thing in the world, and suddenly the investor sentiment and interest and willingness to invest has changed, right? So I think the quick shift in sentiment and willingness to go over in other sectors has also been a surprise.
Okay. No, but that's interesting. So it sounds, at least to me, like you don't. Sometimes in shipping, of course, we get major spikes or dislocation that leads to some temporary events. But unless I know you disagree, it sounds like the consensus here, at least, is it's a pretty broad-based recovery, and it's and there are no huge inefficiencies. Just out of curiosity, I mean, shipping got a lot of headlines recently, and the Evergreen accident, probably made the front page of every major newspaper. Did that actually have any impact on the market? Any of the markets you follow?
Yeah, I think it certainly had a big impact on the container market, right? We have 1% of the volumes going through the Suez Canal. So that was added on top of already, major logistical issues elsewhere in the container supply chain. So I think it had a major impact.
Yeah,
I'd agree as well. If I can just shoot in, it's important to note. I think it was quite interesting. Usually when the Suez Canal closes, it's a major event for the tanker space, and in this occasion, it was the container liners that really perhaps benefited the most. And of course, that's related to how tight the market was initially when everything kicked off. Little life in tankers, despite that usually being somewhat of an event. So that's an interesting observation on the relative.
Yeah, I think one thing which I'm a bit curious, because it seems most of the things you are mentioning are related to the demand side. That's of course positive to have a broad-based recovery. I think except from Lukas, everyone was more China focused. Everyone felt this is driven by global demand. But no one is mentioning the supply side. Does anyone have anything to add there? At least for some segments, we're looking at perhaps the lowest order book in 3 decades. How important do you think that has been this year and will be going forward? And do you think now that markets are good, are we going to see an ordering in any segments? Any over ordering eventually? Anyone want to take that? Frode?
So I think the fact that at least in dry bulk, I mean, the previous question was the biggest surprises in the dry bulk, and I mean, given how strong the markets have been, one of the more recent big surprises is probably that we haven't seen any ordering, to mention at least. And at least in our view, the fact that the supply side will be muted will be key here. And I mean, we're seeing companies mentioning 2023, late 2023, and maybe even 2024 slots for current discussions. And obviously, that makes us quite hopeful that supply will at least not ruin the market in the very short term. Certainly.
Yeah. Good. So I guess on the back of the improvements we've seen in fundamentals and to in some cases skyrocketing share prices, we've also seen liquidity in the trading of shipping shares improve in some cases dramatically. And I just had a look today. I think some of the Norwegian shares are seeing volumes today that are 4 or 5 times what you had at the end of the year. Curious if you are seeing any notable trends or changes in investor interest. And I guess you guys have a interesting perspective as you're close to your home market, where you typically find some investors that are always interested in shipping. You're probably also the first ones that get the call from the big funds abroad when they want to look at it. So Jorgen, has there been any evolution in the shareholder interest? Who's interested in terms of Norwegian versus international investors? And how do you see that going forward?
Yeah, I think that's been one of the things that has changed, is that shipping once again is back on the agenda, more or less. And of course, as you say, in local markets, I feel there's always some specialist willing to discuss shipping stock, but for the international names, not always the case. And so in that respect, I'd say the delta in terms of who's picking up an interest is coming a lot from abroad. But in general, it's hard to come around that. It seems shipping just in general is also gaining a lot of traction again, from being not very interesting to a lot of investors for a long period of time, and that's of course encouraging for us.
Yeah, and are there any follow-up with you still, Jorgen? Is it generally hedge funds, or are remember the last cycle, big long only funds were owning quite substantial parts of many shipping companies? Are they also starting to get interested?
I think it's gaining interest. One of the issues here is that liquidity is not necessarily too high for many of the names, and that's an issue for some. But I think most of the speculative investments that were done, the last cycle, those that stood behind that aren't necessarily in a position to make the same mistakes again. So the client side has to a degree changed, I think, and it's gaining a bit more headlines, as we've discussed, and I think it's just a broad-based increase in interest, also for long onlys, but also more perhaps short-term hedge fund players.
Yeah, and you, Frode, I mean, do you see that it's a broad-based interest, like Jorgen is saying, or are there any sectors that are particularly I guess in favor or piquing investors' interest these days? And are there any that they simply just won't touch still?
No, I think it's been a lot of focus on dry bulk and tankers and containers. So we've had a lot of investor calls recently, and it's been very well attended. So I think it's a lot of interest picking up now, especially from the US, I would say. It's typically like every 5 years or so, we hear from some of the old names or hedge funds coming in and looking at the shipping, and now they're back. And so there's a lot of people are digging hard into the details and looking at dry bulk, tankers, containers. That's my feeling at the moment, at least.
Yeah, and I guess that's a good transition to another question. So what are the investors focusing on when they're calling? You say digging into details. Are they focused on the earnings of these companies or the net asset values? What is it that you think ticks their boxes these days? Peder, maybe you can take that.
No, I think it's just to take it one step back. I think it's been a bit of a change. So in the early innings of after COVID, container was obviously the hot, became hot quite quickly. Now I would say dry bulk is obviously on top of everyone's agenda, and tankers has been tankers tend to always be focused on for some it's a big sector, but in terms of how these investors look at things, it's a combination. I think a lot of the US investors who are our main speaking partners at the moment are focused on both, but they maybe have a bigger inclination to focus on earnings than maybe Norwegian or Analyst have, who tend to maybe focus more on the NAV approach, which in a way is two sides of the same coin. But American investors seems very focused on the earnings side of things.
Yeah, I guess that's almost a topic by itself that we can come back to a bit later. But another one I want to touch on is I think a case has been made that shipping is not very interesting in a world where everyone has been focusing on green stocks and ESG. And it's clear that there's more interest in shipping these days, but how focused are the investors that you're talking to with the ESG aspect? I mean, as one example, we have EU taxonomy coming, and some of you have done reports on it. And the way I understand at least is if you are carrying hydrocarbons or fossil fuels as a cargo, you can never get the score on EU taxonomy. So are there people calling you, Lukas, saying I want to look at shipping because supply demand looks interesting, but it has to be people who don't carry fossil fuels?
Yeah, I think that sort of if you take a step back and see sort of the increase in the interest in shipping, I think also it has to do with last year, or at the end of last year, you have this you had this green tsunami where everything that was even remotely green was being funded without a problem. Now that has sort of that momentum has evaporated a little bit, and people are taking a new view. They are talking about cyclicality, and suddenly they have a sector which is actually making money, and then it sounds sort of compelling, and it's coming sort of out of a, you could almost say, a decade-long downturn. So for some it's compelling, and then obviously you have the ESG aspect, which is gaining traction, and I think the companies have done some serious job on that the last 2 years, because it's no longer something that you can hide under the table. And I think it sort of varies a bit. You have some investors who have actively walked away from it because of the exposure towards hydrocarbons in any form, whereas some sort of still see the rationale for being invested, but are maybe more demanding with regards to disclosures or compliance with the rules, which over time I think will only get stricter and enforced in a sort of a faster and more I would say compliant manner.
So I mean, I agree, and I think you are definitely seeing investors paying more attention and want to be aware of what they're investing in environmentally. What about governance? And this has also often been, I guess, an excuse by investors not to invest in shipping. Is there much focus on corporate governance, third-party management, these type of things, or do people don't really care as long as the cycle is going up? Lars, any views on that?
Well, I think as long as the cycle is going up, the focus is less on governance. But I agree with what Lukas said, and I think generally on ESG, probably the long-only institutional investors, they tend to focus a lot on the E, obviously, but the G is maybe more important for smaller private investors, and they focus maybe more on sort of fee leakages and so on. So you always get questions, but now that the markets are so strong, I feel that the focus is less on that. That's at least my impression these days.
Yeah. And how much are investors focusing on the upcoming regulations? Because we are seeing some rather dramatic changes likely to take place. I guess we'll know after the IMO meeting, which is coming up shortly. Are people looking at EEXI and CII and asking for, I guess, analysis that goes a little bit out of just looking at valuations? Are people looking at all to make sure that they're investing in future-proof fleets. I don't know if anyone have done much work on that, but Jorgen, any views or any input? Sure.
Definitely interest in the subject, particularly when you're talking about the XI and such from 2023 onwards. I think it serves perhaps more as a backdrop to the underlying fundamentals and how things are set to develop on a sector level. As of yet, at least, that's my perception, talking to investors, rather than specifics on a company by company basis necessarily. So that's, but that's definitely one of the factors that works in and makes, I think, investing in shipping perhaps a lot more interesting now than it has been for some time. So yes, there is focus, but I think more on an aggregate level, and the effects more on the supply and demand side as of yet. We're still waiting for the regulations to be decided on specifically by next month. So that will be interesting to see.
Yeah. So I guess, I mean, part of this perhaps should be for you guys to give some advice to people how to invest in the sector. And I think someone mentioned earlier that the US investors are a little bit more cash flow focused than you find in Norwegian counterparts. What about you guys when you are analyzing companies and you're trying to make a view for the future? Number one, do you agree that everyone on this panel is more NAV focused than cash flow focused? And I guess what will be the most important driver of the share prices going forward, the development in asset values or cash flows? Of course, they move together to some extent. But I still think it's interesting, and also whether your approach to valuation changes depending on where we are in the cycle. I think I'd like to go around the table on this one and let you talk a bit freely. I guess, well, how should people value shipping stocks? Jorgen.
Yeah, and I guess part of that relates to us being, as you started off saying on this panel, that Norwegian analysts usually have been around for a long time, and a lot of that time you're not facing companies with any earnings to talk about, so it's good to talk about NAVs instead, and that's been, I guess, where we're coming from. But now, as you're looking ahead and earnings are in place, and there's more interest on, as has been mentioned, from international investors looking through the cycle and looking at cash generation and yields rather than NAV, that changes somewhat. So in our view, it's a combination. I think you have some times that are quite special, as for instance in the container segment right now, where I think it's natural to have a view at what sort of the normalized valuation here, and then you consider how long is this cycle going to last and how much cash is that going to generate. So at least from our perspective, it's something that changes a bit, and a combination of both earnings and underlying assets, although they are tightly connected, of course, the valuation of the underlying assets as well.
Yeah. So, Peder, do you agree, or do you have any other recipes for navigating valuations in shipping?
No, I think Jorgen makes a good point in terms of the lack of earnings makes you focus on NAV, but I think NAV is a very good tool to use when trying to time the trough of the market, right? So you can look at where asset values bottomed out and kind of look at the historical discounts and premiums to NAV. But as you kind of progress, I think you need to incorporate some cash flow metrics into your valuation. So no, I completely second what Jorgen said.
Yeah, and you other guys, Lukas, what's your approach to finding value in shipping?
No, that's hard work, but no, I mean it's sort of the same as has already been mentioned, and I think that over time we have sort of seen different approaches being applied. I think that we have sort of seen that maybe investors are now less willing to price a shipping company with the volatility earnings on a dividend yield, which might have been possible 10, 15 years ago. We'll see if that comes back if we have a sort of a strong cycle. But it sort of makes with the NAV approach, you always have a firm ground on where you sort of where you know what you would get if you were able to sell those vessels, at least in a theoretical sense. So that makes it sort of a bit more protective in a downward scenario. And then if things starts looking better, then obviously you move and look at the potential for earnings, having in the back of your head what is sort of the what is the normal earnings capacity of each particular company. So I think a combo is what everybody goes with.
Okay.
If I could add to that as well, just because it's quite interesting, just looking historically at shipping, it's of course a very volatile space to be. And a lot of interest is in huge fortunes being made, and I guess a lot of that is done looking at NAVs and trying to forecast when the asset values start to turn up. So it's been sort of an asset investing play in order to time those cycles, I think, and people looking at high double digit returns on their equity investment rather than looking at 10 to 15% dividend yields, just relating to how intrinsically volatile the business has been over time.
Yeah, no, I agree. I mean, it seems very rational to look at NAVs, at least in the low point of the cycle. But Frode, is there a risk if you get too stuck on the NAVs that you're looking in the rear view mirror in the cycle moving upwards, where asset values might be moving quicker than broker quotes, and where you tend to forget, if you're looking at last quarter's balance, the cash that's been generated in between?
Good point. I mean,
sorry?
Yeah, that's a good point. I think you bring up a good point. But I think you should, I think at the moment, there's a combination, as somebody else said. People look at NAV, like forward NAV, including cash flow. That's typically one conservative approach. You take the current asset values, and then you say you have like a forecast on rates for the next year or so, and then you look at what's the NAV in 1 year's time. That's one common approach. And of course, I think you should also look at where the cash and cash returns are, right? So if you look at the broker quotes today and you look at the day rates, 1 year time charter rates today on a Cape, which is roughly 30,000 per day, if you plug that in, then you can get 20% cash and cash return. And historically, it's been between 11 and 12%, right? So it tells you that asset values are going up, right? So it's very fair to assume some type of asset appreciation. And so that's a common approach to evaluation, of course. So people are listening and appreciating, what is the next likely asset value and what is the NAV at that point. But as you alluded to, I think, like, if you look at the underlying earnings, you could look at 20-year average earnings, which I would call mid-cycle earnings. And then you can compare what's the earnings or EPS using those type of rates, right? So if you plug in mid-cycle VLCC rates of 40,000 per day, that gives you some type of goalpost, at least. Over time, you need 40,000 per day to invest in a VLCC. So over time, rates have to go up to that level. And then you can ask, what are these companies earning at that earnings level? So that's, I think, like, if you are in a low point in the cycle, that is a natural target to look at. And so you definitely need to be forward looking, and you can't really look at the current NAV. As you said, that would be probably looking in the rear view mirror, right?
Yeah. No, I think, I mean, we've talked about how we were surprised. We've talked about the current, and you even have told people how they should value shipping shares. So let's try to look a bit forward. And Frode, I'll stay on you, because you were one of the shipping analysts that were active, and you were around in the boom of 2003 to 2009. And of course, a lot of this, what we've seen in shipping recently has been about coming up from a 10-year depression, more or less. But we are increasingly hearing people bringing out the S word, super cycle, both in commodities and shipping. And again, Frode, you saw the previous super cycle. Are we about to enter another one? And if so, what similarities or differences do you see now versus then?
That's a good question. I mean, what is a new super cycle? Not in commodities, I presume, right? It's that's difficult to say. Like, what's the definition of super cycle? It's probably a very long, like a decade-long bull run in commodities. I'm not sure if that is the case now. You definitely had that super cycle from 2003 until 2008, but that was driven by China and that growth. Of course, you could argue that we are, because of ESG, etc., people are less willing to invest in new mining, so that could constrain production. But I don't see any new China at the moment, right? So, of course, you could, in some minerals, in battery minerals, it's probably some very long-term cycles ahead of us. But in my view, I think you should definitely look more on what I call the shipyard cycle, right? Because that is really about asset inflation. It's linked to what we talked about earlier, right? But in that same bull run from 2003 to 2008 or 9, you had asset values consistently appreciating. And it was because new orders came in, which were a lot more than the shipyard industry could handle. And since that time, you only had 2 periods where you could really compare, right? Back in 2013 and 14. At that point, people were willing to order a lot of ships, and orders into the yards were a lot higher than the capacity to build ships, and that led to higher backlogs at the yards, and that were allowing the yards to hike prices. And that basically lifts the whole asset value curves. And so even if the markets were weak, you saw NAVs improve. And you see the similarity today, where people are starting to order a lot of ships, and year to date, we are well above shipyard capacity. So the order backlogs are expanding again, and that's leading to higher new build prices and again lifting asset values. For instance, in tanker market, where you have had very bad rates, but still the asset values are up and the NAVs are up and the stocks are up. So it's a similarity. And when I look ahead, I see that the total order books are very low still, right? In dry bulk, it's less than 6% order book compared to the fleet. And even if you factor in containers, it's the world order book in any shipping segment is just around 8%. So it's still like 25-year low order books. And we know that because of the new fuel and carbon emissions, etc., coming up, there's going to be a lot of replacement of ships. So that is likely to expand that, what I call shipyard cycle. So I think that is interesting, more interesting than whether we are in a super cycle in the commodities or not.
Yeah, no, and I think the question was mostly whether we're in the super cycle for shipping with commodities in parentheses. But you bring out some good points. I mean, of course, no cycle looks exactly the same, and I think everyone probably agrees there's a lot of similarities. And now, from what you saw in the early 2000s, I think you point out that you don't see another China, which I guess would be the big one on the demand side. Another thing that happened last super cycle was that we saw a lot of buildup in yard capacity. And I know, Peder, you guys have also focused quite a bit on the yards. Could that be, I guess, the positive delta from the last time we had a similar setup in shipping? Or do you think that yards are going to be built in in beaches and be funded all over the place once prices are high enough?
I think I'm leaning towards the latter, but I think there's a big difference if you look at, if you take DSME for an example. They used to have the majority of their backlog or their order intake used to be on the offshore side, right? So they obviously shut some of that down, but I still think there is capacity, but it takes obviously time. So a lot of things could happen on the asset side, before we get built up capacity to meet potential new orders, as Frode says, to meet the new requirements. So I unfortunately think that over time, if the prices are right, capacity will come back.
But where because that is probably one of the bigger risks. If you are in the super cycle camp, a lot more ships being built is clearly what tends to ruin most cycles. But where do you see that capacity? Are you talking about capacity in existing yards, or are you talking about new yards being built? Because there's been a lot of yards, particularly in China, that are no longer around, and also where the land has been rezoned for other uses. So where is it you see this capacity coming from?
No, I think
how quickly will it come on?
It's difficult to say. I don't know exactly how quickly it will come back, but I think if you think of what's happened in the past, and you make some good points in terms of capacity being shut down, and most likely some of it for good. But I think if the capital is flowing into shipbuilding again and the margins are strong, then there will be capacity somewhere. But I think you make a good point in terms of that they might be more restricted this time around than what was the case 10-15 years ago.
Yeah. So I guess just looking at the time here, let's move on a bit. I guess I'd like to ask everyone, you are analysts, you make recommendations, this is your golden opportunity. 30 seconds, for each of you, what's your top sector pick and worst sector pick for the next year, and why? Starting with Lars.
So we still like dry bulk for the top sector pick. I mean, fleet growth will be low. We think that given predictions for GDP growth, the demand side will also be very healthy. And also, if you look at forward NAVs, it's not like it's fully priced yet in our view. So even though it's maybe priced at 1.2, 1.3 times current NAVs, the discount is probably more like 30%, 1.5, 2 years down the road. So the dry bulk sector for the top pick. And I think for the tanker segment, too much optimism is priced in at the moment. I mean, if you look at oil market predictions, then OPEC will probably produce around 28 million barrels of crude in Q4 this year. That's about 1 million barrels shy of 2019 Q4 2019 production. Fleet is up by 7-8% in the meantime. So priced at 8 to 10 times 2022 earnings at $35,000 per day for the VLs. I think the risk reward is not particularly good in the tanker space at the moment.
Okay. So Lars says buy more bulkers, sell tankers. Jorgen, what do you think? Where would you place your money?
We still like LPG, so the VLGC space I think looks very attractive, just considering the current valuation, the fundamental outlook in the next couple of years, and the current valuation. The only scare there is really the order book, but I think there's a whole lot of regulatory pressure coming into effect in that space once you look to 2023, and I think that keeps it interesting. In terms of the worst pick, I'd have to highlight containers, where we are waiting for the correction, essentially.
And what's going to drive that correction?
just a normalization of things. Looking at the general trade levels, I think, and the volumes, they're not in place to keep this thing afloat for very long. And I think that's a consensus view as well. So perhaps not too deviating, but still looking at how certain stocks are priced at the moment, they're reflecting much more of a positive view than we have.
Yeah. And Peder, what is Fearnley's recipe for success from now and the year forward?
It's a long way to look a year forward in these volatile times, but I think if I have to put on the longer lenses here, I think I would say tankers with a 1 year plus perspective. I think we're going to get support on the asset values just from what we recently discussed in terms of the yards, steel prices rising and increasing backlog at the yards, and it's a good option on the recovery into 2022. In terms of the worst sectors, we don't really have any, obvious shorts. I guess one we could highlight that has maybe run, way past our bull case is it's not necessarily purely shipping-based Cheniere, which has had a very good run. That I think it's getting pretty fully priced here.
Okay, specific advice there, Frode. What is Clarksons, the world's largest shipbroker? What should investors do with their money?
Buy tankers. I think it's a very simple case. I mean, if you look back historically, each time OPEC goes from cutting production to raising output again, you make money in tankers. And I like to often compare it to 2002, 2003, because you have the same low fleet growth now as back then, basically below 2%. And in late 2002, OPEC increased output by 1.5 million barrels per day, and the rates went from 20 to 70,000 per day over just a few months. This time around, we know that OPEC Plus basically has cut 7.5 million barrels per day, and depending on your view on oil demand, I think most of that will come back at some point. Our case is like between 3 and 4 could come back in the next 6 months. So, but within the next 12 months, I think all the 7.5 million production that is now voluntarily held back will come back to the market. And that is basically 10% on utilization. So if you look at, if all those 7.5 million barrels come back, day rate will be going from current levels of 15 to more than 100,000 per day. That's a very easy bet in my view. That's the topic.
Yeah, that sounds quite exciting. What about, is there anything to be negative on here and going forward?
It's hard to be negative when we have this positive view on this, especially on the IMO 2023. We didn't cover that very much, but it's going to lead to slow steaming, right? So if you talk to DNV, etc., they're talking about 1 knot speed reduction across any shipping segment, and that's between 5 and 6% on utilization immediately. So that's even in container, you will have very good help from that level. But purely on valuation, the only thing I don't have buy on is Maersk, which is purely on valuation. It's already very fairly priced.
Yeah, so you agree a bit with your colleague at DNB there. And lastly, Lukas, what is ABG's best recommendations, long and short?
Yeah, I would just say, that 1 year is a really long horizon in shipping. So, but in the essence of time, I think I'm just gonna say maybe use some movie titles or movie quotes. So I think on the container side, which would be the short, that would be As Good As It Gets. And then on the long side, I would say LNG, quoting everybody be cool, this is a robbery, right? So.
Yeah, I like the catchy titles. It probably makes your clients open the research. So I think we're getting towards the end, but you know, shipping tends to never be average, you know, and we when things turn, we often get some bold numbers. Frode threw out a bold statement. He sees VLCC rates going to 100,000 a day. So slightly as an invitation to Nicholas as well, I hope that this Norwegian capital link can become a tradition. So on the assumption that we'll have a panel a year from now, I'll ask everyone to make a prediction. So what will be the peak Capesize and VLCC rate within the next year? And what will be the value of a 5-year-old Capesize a year from now, Lukas?
Okay, then starting with the rates, Cape average 21, max 44. VLCC average 23, max 44. Make it simple for you.
Okay, I'll write this down. And Lars?
Peak VLCC rates 40, average 24. Peak Cape 50, average 30.
Okay. Frode?
Peak VLCC 100 and peak Cape 50. And the asset values, 5-year-old Cape should be 52 exact. VLCC 85, 5-year-old.
Yeah. And what about you, DNB? So the shipbroker who's selling ships is very bullish. He's telling his clients to go on the West Coast, rates will be high. What about the sober bank? What do you predict?
Yeah, sure. So on the asset values, then to start off, let's say mid 40s for the Cape. So say 47, and for VLCC, let's say 74 to turn that around. And in terms of rates, peak rates for Capes, I'd say mid 40s or around 45, and peak for the VLCCs, not too far off from the same space, I think. So 40, 47, I feel lucky.
Okay, good. And Peder, you're the last one.
All right, we'll start with the rates. So VLCC peak 65, average 35. Cape peak 40, average 26. 5-year VL 78, and 5-year Cape at 46.
Well, thank you. So we've now had the retrospective look back. We've learned how to analyze shipping companies, and we've gotten some bold predictions for where to place your money for the next year. I think with that we'll wrap it up, and a special thanks to Nicholas and his team for doing Capital Link in Norway. And we hope to see you next year.
Well, I reciprocate the thank yous to you, Magnus, and to our panelists. Thank you very much for a great discussion. We actually exceeded the time, but we had the opportunity to go into more detail, which was terrific. We plan to do this every year, and now I have one more incentive to do it, so we can go back and check what we said this year. So thank you again. It's been a great 2-day period, and I have to say I'm delighted and privileged with the reception that our forum has gotten. So we look forward to next year, and tremendous thanks to all of you. Thank you.
Thank you so much to everyone.
Thank you.